Okay, guys. So welcome to the Strategic Business Reporting Revision Marathon session. We are going to conduct a session which we will be covering question number 2, 3, and 4 from the different examination paper that are available on the ACCA CB practice platform. I would try to cover up maximum questions so that you can have a good idea, you can have a good practice. You would try to do those maximum questions to be covered up. So let's just start off. Let's just start discussing and let's take things forward. Uh, okay, okay. So what do we have? I'm actually going to start off with the SBR practice examination that is available on the AACCA website. And on this practice examination, there is obviously section A and section B. I'm not going to be covering section A. I will be covering section B. In fact, section A question 2, I'll be covering. So I'll be covering section A question 2, then section B. So let's just start off. Let's just start discussing. This is one of the past examination question, the name of which is Farem company. Can you just read through this specific area of the question, please? Okay, now. So it says Farem company is a manufacturer of domestic goods. Farem operates a profit-related bonus scheme for its managers based upon consolidated financial statements, but recent results have been poor and the bonus targets have rarely been achieved. So what happens is that they operate a bonus scheme for their employees and the recent performance has not been good for Farem company. That's what the information is. Now it says as a consequence, the company is looking to restructure and sell its 80% owned subsidiary New Wall company. What are they planning to do? They're planning to sell their 80% owned subsidiary New Wall company, which has been making substantial losses, which has been making substantial losses. The current year end is 30th June 2008. The following exhibits available on the left hand side of the screen provide information relevant to the question. So there's something called factory subsidence and there's something called sale of new wall company. Something called factory subsidence, something called sale of new wall company. Now, uh, can you just read through this factory subsidence so that we could start discussing? Yeah, can you read through it? Okay, what does it say? It says Farem has a production facility which started to show signs of subsidence since January 2008. Subsidence is like damage. Subsidence is like getting obsolete. That's what it is. So it had a factory which showed signs of subsidence, right? Now, what actually happens is that they have decided it is probable that Farem will undertake. Probable that Farem will undertake a major repair during 2009 to correct the problem. Farem does have an insurance policy, but it is unlikely to cover subsidence. The chief operating officer refuses to disclose the issue at 30th June X8 since no repair costs have yet been undertaken, although she is aware that this is contrary to international accounting standards. Chief Operating Officer does not think that subsidence is an indicator of impairment. She argues that no provision should be made because there is no legal or constructive obligation to repair the factory. So she is arguing that there is no legal or constructive obligation to repair the factory. So I'm not going to book any provision also. Now, Farem has a revaluation policy for property, plant, equipment, and there is a balance on the revaluation surplus of $10 million in the financials for the year ended 30th June 2008. None of this balance relates to the production facility, but the COO is of the opinion that the surplus can be used for any future loss arising from the subsidence of the production facility. Now, what exactly is the requirement of the question? It says, discuss the accounting treatment which Farem should adapt to address the issues above for the consolidated financial statements. So there are multiple issues, and you need to tell that what is the accounting policy that they should adapt in order to address each of these issues for the consolidated financial statement. Now, can you just try to write down few pointers about this area? What do you think should be the pointers for this area? Yeah, just think about the pointers that you're going to write for this. Okay, now see. Okay, Gladys, thank you very much for the inputs. Now let's just try to see. There are a few pointers which I would like to share with respect to this scenario. I've just opened the word processor. I'm just going to make it very small, the word processor, so that I could probably write down the answers where I need to. It says Farem has a production facility which has started to show signs of subsidence during January 2008. So subsidence is an indicator of impairment. Is an indicator of impairment. It is probable that Farem will have to undertake major repairs sometime during X9 to correct the problem. Farem does have an insurance policy, but it is unlikely to cover subsidence. Chief Operating Officer refuses to disclose the issue at 30th June X8 since no repair costs have been undertaken, although she is now instead of disclosure, impairment, recognition, and disclosure needed as per IAS 36. Furthermore, what else is there? Furthermore, it says that CEO thinks that subsidence is an indicator. She argues that no provision for repair. Okay, correct. That no provision should be made. Farem has a revaluation policy for property, plant, equipment, and there is a balance on the revaluation surplus of 10 million. None of this balance relates to production facility. Okay. Revaluation balance of the relevant asset to be used for offsetting the losses. Now, let me just guide you all. Let me just take you through that what should be done. See, you have to answer the question and you have to explain to the examiner that what should be the accounting treatment of all this. Okay, you would say subsidence at the factory is an indicator of impairment. The factory seems to be the major part of the Farem business, and it is highly likely that they will have to. Subsidence at the factory is an indicator of impairment. The factory seems to be the major part of the Farem business, and it is highly likely that they will have to. It is highly likely that they will have to undergo the repair and maintenance. The impairment testing should be performed for the factory by comparing the carrying amount of the factory with its recoverable amount. The recoverable amount being the higher of fair value less the cost of disposal. The fair values shall be established using IFRS 13 and the shall be established using IFRS 13. Fair value less cost of disposal and the value in use. The value in use shall be the present value of the future cash flows discounted using the relevant rate of interest. Any impairment loss should be recognized in the income statement as none of the revaluation surplus belongs to the factory, and it is not allowed as per the IAS 36 to recognize the impairment loss pertaining to another asset against pertaining to an asset against the revaluation reserve of another asset. The COO is correct in his interpretation that no provision is required as the repairs are not mandatory, are not required to be done as neither a legal nor a constructive obligation arises with respect to the repairs of the factory. You get my point? So always remember, just put down some pointers for yourself. Once you put down some pointers for yourself, those pointers are gonna act as a guidance. Those pointers are gonna act as a guidance, right? Those pointers are gonna act as a guidance and they'll guide you as to what should be done. Yeah, is that okay to you? Is that okay to you people? Okay, lovely. Now we just move on to the next part of the question, which is like sale of new world company. And what I would want you people to do is that to read through this question and try to see that what could be written down with respect to the answers for this question. Sale of new world company. Sale of new world company. Yeah, can you read through this and can you just plan out the answer here? Okay, it is basically on the ACCA website. It's SBR uh, Practice Exam 1. It's SBR Practice Exam 1 Faith. Okay, let's just start off. So basically, now what do we have? We have got the sale of new world company. Now it says Farem Farem had a plan to sell its 80% subsidiary New Wall company. This plan has been approved by the board and reported in the media. It is expected that the old castle and entity which currently owns the other 20% of New Wall will acquire the remaining 80% equity. Sale is expected to be completed by December 2008. So sale is expected to be completed by December 2008. New Wall is expected to have substantial trading losses in the period up to the sale. The accountant of Farem wishes to show New Wall as a held for sale in consolidated financials and to create a restructuring provision to include expected cost of disposals and the future operating losses. Chief Operating Officer does not wish the New Wall to be disclosed as held for sale nor to provide for the expected losses. CEO, COO is concerned as to how this may affect the sales price and would almost certainly means bonus targets would be met. COO has argued that would almost certainly mean the duty to secure high sales price to maximize the returns for shareholders of Farem. She has also implied that the accountant may lose uh, okay, accountant may lose her job, right? Now, she has also implied accountant if were to put a such financial statement, expected costs from the sale are as follows: future trading losses are this, various legal costs of sale are this, redundancy cost is this, impairment losses on owned asset is this. Included within the future trading losses is an early payment penalty of $6 million for the leased asset, which is deemed surplus to the requirements. Now, what do you think should be the answer? Okay, no provision, no current obligation. That's what you're saying. Okay, ladies, let me just take you people through. Again, what I'll do is that I will adopt the same approach here. I would just make it a slide like this. Now, sale of New Wall company. Now, if I talk about the sale of New Wall company, let's try to understand this. Basically, what actually happens is that when we talk about the sale of New Wall company, you would need to understand the key pointers. The key pointer is that plan to sell the subsidiary. Is it a disposal group? Does it mean criteria? Does it meet criteria for capitalization as held for sale? So plan to sell the machinery. Is it a disposal group? Does it meet the criteria for capitalization as held for sale? Recognition of provision for restructuring. Then what else is there? What to be included in the provision? Future operating losses should not be included. Within the provision calculation. Only early termination penalty be recognized. Okay, now we have got the pointers now. What I'll just do is that I'll just try to elaborate the answer so that I could give you a clearer and a detailed picture as to what should be done. See, the plan to sell, okay, the subsidiary which is going to be sold will be a disposal group if it meets the criteria for the classification as held for sale. If it meets the criteria for the classification as held for sale. Now what next is there? How would we do that? How would we go about it? Let's just see. In order to classify as held for sale, the conditions that are required to be met seem to be met in the current circumstances. Now, what are the conditions that are likely to be met in the current circumstances? Let's try to understand this. It says had a plan to sell subsidiary. The plan had been approved by the board. Plan approved by the board. Plan approved by the board. Buyer is available. Sale expected completion within 1 year. Sale expected completion within 1 year. Assumption that rest of the conditions are also met. Now, you're not just going to write down the answer like this. You would say plan for the disposal has been approved by the board. See, you need to get the marks for the communication also. How would you get the marks for the communication? This is going to be like this. So anyways, you got to elaborate and you got to write short paragraphs for it. So I've just written down the pointers here. I will move forward. So now what has happens is that you would say that subsidiary which is going to be held so and so, so and so. Now, since it meets the criteria for the classification as since it meets the criteria for the classification as held for sale, therefore the results of the subsidiary shall be presented as the gain slash loss from discontinued operations in the consolidated financial statements. Right? Since it meets the criteria for the classification as held for sale, therefore the results should be shown as what? As basically gain or loss from discontinued operation in the consolidated financial statement. The net assets of the subsidiary should be shown at the lower of fair value less cost to sell and the carrying amount. It should be shown at the lower of fair value less cost to sell and the carrying amount. right? Okay. So what happens is that since it meets the criteria for classification, therefore so and so the net asset should be shown at the lower of fair value less cost to sell and the carrying amount. The assets of the subsidiary shall be shown after the current assets as assets held for sale, sorry, as disposal group held for sale, and the liabilities pertaining to the subsidiary shall be shown after the current liabilities as the liabilities held for sale. These assets and liabilities, if they fall outside the scope of IFRS 5, then should be measured using their respective accounting standards. The provision for restructuring shall be recognized, but only for the past cost and shall not be recognized for any future operating losses and shall not be recognized for any future operating losses. However, the cancellation of the lease is an onerous contract and shall give rise to the penalty to be paid. Therefore, the loss and the provision of $6 million relating to it shall be recognized. Furthermore, what needs to be done is that there it says various costs, legal costs of sale, redundancy costs, etc. etc. So, furthermore, the provision, just a second, right? Furthermore, the loss shall be recognized and a provision also for the redundancy cost pertaining to new wall company employees. So this is how you would actually write down the answer, right? This is how you would actually write down the answer, right? You get it? This is how you're gonna write down the answer. Right? You get it? Okay. Now let's move a bit forward and let's discuss further. So do you understand this? Yeah, do you understand this? Okay, lovely. Now let's move on to the last requirement of this question, which is basically, um, which is it says discuss the ethical issues arising from the scenario, including any actions which Farham company should uh, uh, sh- and accountant should undertake, right? So you have to actually talk about the ethical issues. You have to talk about the ethical issues from the scenario. Now it's a 7 mark requirement. That means you could probably be talking about the 7 pointers. Now I'll just open up different things and I want you to actually try and identify. See this? Can you identify anything here? Yeah, see this? Can you identify anything in here? Yeah, see if you can identify anything in here. Anything on this page? Profit related bonus, right? Operates a profit related bonus scheme. So that's one pointer, right? Profit related bonus scheme. So when I would talk about this ethical issue, I'll put in the questions requirement also. So with respect to the ethical issue, one of the thing is that they operate a profit related bonus scheme. Anything else also on this page? Anything else in here? Okay, apparently poor performance. Okay, poor performance of the entity. That's one more thing. Okay, let's move a bit forward. Okay, can you look at anything in here? Yeah, anything in here? Yeah, anything in here? Anything from here? Okay, CEO is refusing to disclose the issue. Okay, yes. Chief Operating Officer's refusal to disclose issue. The lack of knowledge to recognize the impairment loss. Okay, here, do you have anything in here? Okay, intimidation, threat, right? Not willing to disclose or not willing to classify as held for sale, right? Okay. So if I talk about all of this, let's try to understand this. Basically, these are the different ethical issues that are arising. So what is the requirement of the question? The requirement of the question is discuss the ethical issues arising from the scenario, including any actions which Farem company and the accountant should undertake. So you see, you would be discussing these issues, but I can talk about few things, which is staff training. Staff training. The one thing that you can talk about is the staff training. One thing that you could talk about is the staff training. Okay. The second thing is like that is gonna be covered by the staff training. That is gonna be covered by the staff training, right? Okay. What else is there? Then you would have this that accountant should discuss with management, some senior within the organization, may consider reporting to the professional organization, right? That's what you should do. So he may consider reporting to the professional organization also. So we are actually done with this specific question, the name of which was Farem company, and it covered up the area of the impairment, the provisions, multiple things were actually covered up in this specific question. So I hope that you do understand this question right now.